Have you ever felt that gnawing sensation in your gut on a Sunday evening, dreading the alarm clock and another week of trading your precious time for a paycheck? That feeling of being trapped, knowing there must be a better way to secure your financial future? What if I told you that in 2026, there's a proven investing strategy, one that quietly generates income into your bank account month after month and has the power to not just supplement, but entirely replace that soul-crushing 9 to 5 salary? This isn't about risky day trading or complex real estate flips. It's about a methodical, accessible approach that thousands are using right now to build true wealth and reclaim their freedom. For many, the problem is clear. The traditional path feels like a dead end. You work hard, you save a little, but the idea of true financial independence, where your money works for you, seems like a distant dream. Inflation erodes your savings. Market volatility feels like a constant threat, and the idea of relying solely on a single employer for your livelihood is increasingly precarious. The desire for passive income, for a financial cushion that grants you control over your time, is stronger than ever in 2026. But how do you, as a beginner, navigate the complexities of investing and find a strategy that actually delivers on that promise? The answer lies in a refined 2026 dividend investing strategy, one that focuses on consistent income generation and strategic growth. Let me break it down into actionable steps, complete with realistic numbers, to show you exactly how this can be achieved. Step 1. Build your foundation, the seed capital phase. You need a starting point. Let's assume you begin with a modest but consistent commitment. Perhaps you can save an extra $500 per month from your existing income, or perhaps you have a one-time bonus of $5,000 you're looking to invest. Let's use the latter as our initial example. If you begin with a $5,000 lump sum, your goal is to grow this into a meaningful base. Step 2. Intelligent stock selection, the income engine phase. This is where many beginners get lost. Instead of chasing speculative growth stocks, we focus on established companies with a long history of paying and increasing their dividends. These are often referred to as dividend aristocrats or dividend kings. Look for companies with strong balance sheets, consistent earnings, and a payout ratio that isn't excessively high, ideally below 70 to 80%, indicating sustainability. In 2026, a realistic diversified portfolio of dividend stocks could yield an average of 4% to 5%. Let's be conservative and use 4% for our calculations. If you invest your initial $5,000 at 4% yield, you generate $200 per year in dividends. Not life-changing yet, but it's a start. The crucial part here is consistency. Step 3. The power of compounding, the snowball phase. This is where the magic happens. Every dividend you receive isn't spent. It's immediately reinvested back into purchasing more shares of dividend-paying stocks. This is called dividend reinvestment planning, DRIP. Let's illustrate this with some numbers over time. Asterisk year 1, asterisk you invest your initial $5,000. Assuming you continue to add $500 per month, an additional $6,000 per year, by the end of year 1, your total investment is $11,000. At a 4% yield, your annual dividends would be approximately $440. Asterisk year 2, asterisk, you continue adding $500 per month. Your existing dividends, $440, are reinvested, buying more shares. Many quality dividend companies also increase their dividends annually by 5 to 7%. Let's factor in a conservative 5% dividend growth rate from the companies themselves. Your portfolio value could grow to around $17,400. Initial $11,000 plus $6,000 new capital plus reinvested dividends plus market appreciation. Your annual dividends could now be around $700. Asterisk year 5, asterisk, maintaining that $500 monthly contribution and the 4% yield with 5% dividend growth. Your portfolio could swell to roughly $44,000. Your annual dividends will be approximately $1,760. Asterisk year 10, asterisk, this is where the compounding truly accelerates. Your total invested capital, including reinvested dividends, could be around $105,000. Your annual dividends would now be generating over $4,200 per year. That's $350 per month. A decent side income, completely passive. Asterisk year 15 asterisk by this point. Your portfolio might be valued at $190,000. Your annual dividends could be a substantial $7,600, or roughly $633 per month. You're now generating enough to cover a significant portion of your expenses without actively working. Asterisk year 20 asterisk, imagine your portfolio hitting $300,000. Your annual dividends are now $12,000, which is $1,000 per month. This could be enough to cover your car payment, utilities, or even rent in some areas. Asterisk year 25 asterisk, with continued discipline, your portfolio could reach $450,000. Now, your annual dividends are $18,000. That's $1,500 per month. This is getting serious. Asterisk year 30 asterisk, a truly life-changing milestone. Your portfolio could easily surpass $650,000. At a 4% yield, you're looking at $26,000 annually, over $2,100 per month. This level of passive income can comfortably replace a significant portion of, if not an entire, average 9 to 5 salary in 2026, especially when combined with other income streams or reduced living expenses. These numbers are illustrative, but they demonstrate the immense potential of consistent investing and dividend reinvestment. The key is starting early and being consistent. Common mistakes to avoid in 2026 dividend investing asterisk. 1. Chasing high yields blindly asterisk. A 10% dividend yield might look attractive, but it often signifies a company in distress, and the dividend could be cut or eliminated. Focus on sustainable yields, typically 3 to 6%, from fundamentally strong companies. Don't let yield traps derail your strategy. 2. Neglecting diversification asterisk. Putting all your eggs in one basket is a recipe for disaster. Diversify across different sectors, e.g., consumer staples, healthcare, technology, utilities, and industries. If one company or sector falters, your entire income stream won't collapse. Aim for at least 15 to 20 solid dividend-paying stocks. 3. Ignoring dividend growth asterisk. While current yield is important, future dividend growth is equally, if not more, critical. A company that consistently increases its dividend by 5 to 10% annually will see your income grow significantly over time, even if its initial yield is moderate. This also helps combat inflation. 4. Not reinvesting dividends asterisk. This is the most common mistake for beginners. If you take your dividends as cash, you lose out on the exponential power of compounding. Set up DRIP with your brokerage account. Let that snowball grow. 5. Selling during market downturns asterisk. Every portfolio will experience volatility. Panic selling during a market correction means you lock in losses and miss out on buying more shares at a discount. Dividend investors often view downturns as opportunities to acquire more income-producing assets cheaply. Stick to your long-term plan. 6. Failing to understand the business asterisk before investing. Take the time to understand what the company does, its competitive advantages, and its industry outlook. Don't just buy a stock because someone on a forum mentioned it. Do your own due diligence. The 2026 Dividend Investing Strategy isn't a get-rich-quick scheme. It's a get-rich-slow, get-rich-reliably strategy. It requires patience, discipline, and a commitment to understanding the fundamentals. But the payoff, the ability to generate passive income that can eventually replace your 9 to 5 salary, is absolutely worth the effort. Imagine the freedom that comes with knowing your bills are covered, not by exchanging hours for dollars, but by the money your investments are generating. That's the power of this approach. Start building your income engine today. Subscribe to ArbitrageHQ for weekly videos on building real wealth.